Hello, ladies and gentlemen, and welcome back to the free live webinars hosted by myself, David Kindley. And this webinar has been brought to you exclusively by Orbex. Today, we're looking at trading with Harmonics. I've been asked a few times over the course that we've done some of these free webinars to go more into trading, looking at patterns, candlestick charts, line graphs, harmonics, Elliott waves is going to be the next up, next time around. And then after that, we're going to look at trading gaps in the market, how to be, let's say, adventurous on these gaps, because a lot of traders don't like to trade on these big opening gaps over the weekend or over rollover or any certain gaps that you see. So these are all coming up in the next few webinars. But today we are trading with Harmonics. So thank you once again for joining me, and let's get straight into the presentation. So just want to go through a quick brief history of what are harmonic patterns and how they were triggered. I won't go into too much of an introduction because, as I said, it does get a little bit boring. I remember visiting some webinars once, well, quite a few times, and the introduction stage is like 20-30 minutes long. And by that time, obviously, attention levels kind of differ for sure. So just go through a few bullet points here. So they are specific formations used in technical analysis that help the traders understand price action and forecast entry and exit levels, commonly referred to as trend reversal patterns that are based on Fibonacci extensions, retracement levels, and geometric structures. Provides a potential reversal zone, which helps to forecast reversal trades at the brink of exhaustion. And it assumes that trading patterns are repetitive once identified based upon the probability that the same historic price action will occur, a trade can be triggered. So before I just go on, I just want to let you know that this is a live webinar, and any questions you want to direct at me, feel free to do so, and we can go through as we get on with the presentation. So just want to do a quick diagram of a harmonic here. This is a Gartley pattern. Also, it can be other patterns as well, depending on where these points finish. But let's just go through what we are looking at and what we are keeping our attentions to. So harmonic patterns are based on Fibonacci levels. The basic patterns have 5 points going from X, which is the starting point, to A. It also goes from A to B, B to C, and C to D. These Fibonacci retracement levels I will go through in detail as we go. I just wanted to point them out as obviously as the presentation goes along. 4 lines connect the above 5 points, either in the shape of a W or M, depending if it's bullish or bearish. So we are looking now at the PRZ, the potential reversal zone, is where a pattern is most likely to reverse in order to enter a viable trade. So what we're doing here is we're seeing these points being completed, X to A to B, B to C, and C to D. And then once D has been established, then we see the reversal zone, and that's where we can enter a trade. Similarly, with a bullish pattern, we go in the opposite direction, looking like an M shape. And when we hit point D, we start moving higher, and that will be where the entry point is located. However, if you do spot a harmonic pattern forming halfway through, these points here, B to C or A to B even, can be jumped upon and can be traded upon as well, depending on what time chart you have on your trading platform. It does work well in longer trading platforms such as weekly, daily, or 4-hourly, or you could probably get it on an hour chart, but it does work more better. Harmonic patterns, easy to identify, let's say, if it's on more of a bigger time frame, which we'll again look for shortly as we go into it. So just a brief history on where did they come from. So a man called Howard Gartley originally laid the foundations for harmonic patterns in his book, Profits in the Stock Market, in 1935. And then in the 70s, another person called Scott Carney took the Gartley pattern a step further and introduced this concept of Fibonacci ratios into the equation. So he basically added a lot more meat to the bone, let's say. And then Carney discovered that these ratios could be applied in an effort to make harmonic trading more reliable. And the 4 main types and most popular are the Gartley, butterfly, bat, and crab. But we've also got the shark, we've got the deep crab as well, and we've got the ABCD pattern as well, just to name a few. So there are quite a few harmonic patterns out there, and but the main 4 are Gartley, butterfly, bat, and crab. So what I want to show you now is a step-by-step construction of how a harmonic pattern is formed and what to look out for as well. So I've chosen a Gartley because it's probably one of the most popular ones, and I've chosen it for a bearish Gartley pattern. So just going back a couple of slides, a bearish pattern is looking like a W. And then the reason it's bearish is because when we hit this D leg, which is the potential reversal zone or the PRZ, then we are going to move downwards. So that's why I want to just show you this one because it's a bit more simple. So the Gartley is one of the most common of the harmonic patterns, like I just said, a continuation pattern to help the overall trend to extend the same direction. So the first step in identifying the pullback from a sharp downturn in the markets. This creates the first 2 points, X and A. Just want to point out that this downturn can be any length. It can keep on pushing lower and lower. As I said, we've got, so I've got an example that I want to show that on my MT4 demo platform with Orbex shortly, but I just want to go through all of these in step-by-step detail. And as I said, any questions you have, please let me know. So we've got the downturn and that's created X to A leg. And now we're looking for a pullback. Now this pullback will create the A to B leg, which we'll now look at in more detail. So the pullback goes as far as the 61.8 Fibonacci retracement of the XA leg. So what does that actually mean? So what happens here is we take a Fibonacci retracement. So we go from 100% here and we drag it down to 0% on the A. And in between that, we get the 61.8 golden ratio of the Fibonacci ratio here. And what will happen now is A to B leg will roughly go about 61.8. It should touch it, bearing a few pips away, could go slightly over or under, but it mostly has that pullback to 61.8. Where I'm saying here, point B does not go beyond 61.8. It could kind of just slide a little bit higher, potentially a few pips, but not much more than that. So that's the first initial point of the harmonic pattern being drawn into place. So X to A, we've got the pullback now from A to B. So now the next leg is going to be from B to C. So once the 61.8% has been reached, the next leg of the pattern merges is B to C. The end of point C can either be between 38.2% or 88.60% of the AB Fibonacci retracement leg. So what does that mean? Basically now we are retracing this leg. So forget X to A now. I'm going to go from A to B, and I'm going to put a Fibonacci retracement 100% from A and pull it up to 0% B. And now we've got a few levels because based on what pattern it is, this is the Gartley, we are going between 38.2 and 88.6. So it actually could end roughly just shy of 38.2, or we could have a deeper pullback to 88.6, but it's important to note that this point C will never go beyond point A. Never, never, never. Otherwise, the pattern is invalid. So we are around this area. It most popularly, difficult word to say there. Most commonly, that's probably easier, it goes around the 50 to 60% area to get a reasonable pullback. So, but important to know that the deeper the pullback for point C, the easier it is in identifying this pattern. So if we go more than 38.2, then it's an easier setup and an easier pattern to identify in that characteristic there. So, and lastly, we are now looking at C to D. Now, how is this formed? So another upturn after the bounce, and this leads to correction of C to D. So we've got our point C, and now we are bouncing up and we're going higher. So point D is confirmed when it breaks past point B at the 61.8%, sorry. So once we've gone past this 61.8, we are now getting into that harmonic pattern being more and more obvious in the MT4 platform or whatever platform you are using. So once it breaks, it will run up to approximately 78.6%. It won't really go too much more than that, and I'll show you why shortly, because every pattern has different characteristics of the Fibonacci retracements and extensions as well. And important to note that the same Fibonacci retracement used for the XA move is used to measure this CD. So really you could leave the original XA, or you can draw another one. It's not really that difficult. So what we're going to do is go again, 100% Fibonacci retracement all the way down to A. And then we're going to see this 78.6 being moved. So that's what we're looking for at the moment. And then finally, the final point in the pattern is point D when it is established. This is also a confluence of the 1.272 Fibonacci extensions of points ABA. So what we're doing now, we're getting an extension tool out with a Fibonacci extension. So where it's a Fibonacci extension tool is made of 3 points, and we're going to go from the start of A up to B and back down to A. And I'll show you all this on a live platform shortly. I just wanted to get the basics out of the way just to show you more details. So ABA, and then we have also an extension of 1.272 on the Fibonacci extensions. The extension tool is used to give a strong indication and confirmation for reversal. So it's like a double whammy. So what we're doing here is we're not only looking at the retracement of the 78.6 of line X, point X to A, we are also confirming this with the ABA extension tool to give us a clearer clarification, of where point D is going to be exited and how it's going to be made. Point D, however, can run up to the 1.618, but does not go beyond point X, which is very, very important. So as we saw on the original Gartley pattern, it's this W feature does not, this point D does not run higher and go above point X. It can probably just go a little bit higher here, but the 1.618 is the terminal point where it will not go above. Another couple of important things to kind of take into consideration is if the retracement of B and C is 38.2% of A and B, then C and D should be 1.272. So what I mean by that is if it's a deep correction, if this goes even deeper, then we could see more of a push to the upside. And consequently, if B and C is 88.6 of A and B, then C and D should extend higher. So that basically means if this is more of a move to the upside, then this can be, it can basically point D can move higher. So based on the actual length of the lines from B to C and C, from A to B and B to C, it can actually differentiate how much of a push this point D could get, which gives you could give you a bit of an indication on how far this harmonic pattern will push. So where do we look for when we're looking for entry prices, take profits, and stop losses? So for investors looking to trade the pattern, a sell position is opened. Just a reminder, this is for a bearish Gartley. So a sell position is open once reversals hit point D. So once we hit point D and we see the market retracing lower, then this is time to open our positions. And then it depends on your trading strategy and how confident you are where you want this first take profit or second take profit, or maybe not even a take profit at all. Maybe you feel like the market is going to keep pushing lower and go past point C, go past point A, and keep on pushing as well. So this is just a retracement from A to D now, as you can see. So we've put it at A, and we're looking at the 38.2 first of all, and the 61.8. These are the most common take profits that traders usually put in the markets for harmonics. It's not set in stone. It's not in the rule book. It's just a case of how many we are, how confident you are on the take profits, and where we're looking in that direction as well. So with that being said, with the take profits, where do we look at for the other stop loss? I'll put this slide in the wrong way, but I just want to quickly look at where to position the stop loss. Now, we've gone through where to enter the market, but now where to put a stop loss. Well, a lot of traders for this particular pattern put the first stop loss, or put a stop loss on the top of where the harmonic started at the beginning of point X, which is usually roughly about 10 or 20 pips away from point D, which isn't a bad stop loss if you are in dependent on your risk management and obviously your trading style. However, another popular stop loss area is also the Fibonacci extension of points A to B, and that's at the 3.618 as well. So as you can see here, if you don't want to put that stop loss in, if you think it's a bit too low, a lot of traders then bump up to the 3.618, which will probably roughly be about double the amount. Obviously this is not to scale, but it's roughly about double the amount of where point D finishes and point X begins. So that's just a rough estimate there. So what I want to just quickly take you through now is when we see these patterns, they do look very complicated. They look like a lot of numbers, a lot of letters as well. And, you know, what do these other lines mean as well? Well, these particular lines are just to kind of show a harmonic pattern. They don't really mean much in the sense that they're going to give you anything from the market. They're connected to basically look like a more harmonic pattern. What we need to take into account is what these particular numbers mean. So I'll just run you through what we are looking at the moment. So basically, this is a Gartley pattern. So what this 618 means is basically just a retracement, like I said, of the X to A leg. So we've gone to X to A. Now we've done this 100% retracement. I'll quickly just go back to show you. It was on this one. So this is what it means. So X to A, and then we've got this 61.8. This is because it's multiplied by 100, but obviously you can take the Fibonacci how you want, 0.618 or 61.8. So that's what the 61.8 means from there to there. And then these two figures here are basically meaning that we can have from A to B this retracement between the 0.382 or the 0.886. So going back to my previous example, as we saw here, so the retracement of B to C can actually be from 38.2 to 88.6. So that's what those two figures mean as well. 38.2 or 88.6. So that it looks very confusing, but if you understand what the diagram is trying to tell you, then it becomes a little bit more clear. And then we've got C to D, or creating this the C points, D point, and then 1.27 and 1.618. This was the Fibonacci extension. So going back to the previous one, yeah. So as I said, we've got the ABA extension, which can run up to 1.272 and 1.618. So this is basically a Fibonacci expansion to form point D. So that's what those two figures mean. And lastly, we've got the 0.786, and it means a retracement to form point D, which was a Fibonacci from point X to A. So again, going back, that's all that was there, 78.6. So this was the last leg to create point D. So we did a Fibonacci retracement from X to A that we used in the first downturn leg, and then this gave us this particular leg here. So that's all these numbers mean. Basically, it looks very complicated, I know, because when I first started looking at harmonic patterns, I was like, oh my, like, what are all these different Fibonacci extensions? How come one has one, another has two of them, and how comes they differ so much? Well, this is the reason. It's basically, we'll do it on a bearish one as well. So we've got the X to A leg, and then we've got the retracement. So that comes up to 61.8. And then we've got the next retracement down, which can fall anywhere between 0.382 and 0.886. And then we've got the next leg, which is which forms point D. And that's just basically a 78.6 retracement from point X to point A, using the same X to A formation, Fibonacci extension. And then lastly, to get point D, we're doing an ABA Fibonacci extension, which can fall anywhere between 1.27 and 1.618. So this is the Gartley pattern. And as I said, it is something, just want to share that as well, ABA extension to 1.72 to 1.618. So that's what, as I said, any questions, let me know. But this is in essence, how a bullish Gartley pattern is formed and how a bearish one is formed. So when we get at point D, we want to put in a buy position. Conversely, bearish, we put in a sell position. And then based on your risk appetite or trading strategy, you're going to put in take profits at certain points where you feel it's viable, and also a stop loss roughly where it is viable as well. So stop loss, like I said, a lot of traders look at that point X because they don't believe that it's going to, if we go beyond point X, then usually the the market will keep on pushing higher, and then it will wipe out the whole harmonic pattern strategy. However, if we put in a stop loss roughly about the X or the 3.618 Fibonacci extension of points ABA, we are looking now. Sorry about that, I've gone on to the next slide. We are looking at roughly the correct stop loss as well. So moving on to the butterfly. The butterfly is another popular pattern, and I'll take you through another quick demonstration because it's basically the same thing, but I want to take you through another example so you're more comfortable and you have a better understanding of what's happening. So we've got the downturn. This is again for a bearish pattern. We've got the downturn X to A, and then we're going for the pullback now from A to B. So what happens there? We need a Fibonacci retracement from X to A to see where this is going to lie. Now, each pattern on the harmonic has different Fibonacci ratios. Some of them have similar, however, a lot of them are different. So this one now for the butterfly actually goes up to 78.6. Now the Gartley pattern went to 61.8, if you remember, but now we can move higher to 78.6. Doesn't mean that it's going to push higher than that, but it doesn't, as I said, it can go a couple of pips, but usually to 78.6. So we've gone A to B. We've put the Fibonacci retracement from 100% X down to A, and we've got this 78.6. If this was a Gartley, the 61.8 would be about here, and then that's where the line would stop. But we've got a butterfly pattern now, so we're continuing onwards to this next pattern. Now, once the 78.66 level has been reached, the next leg of the pattern is B to C. Now, it's important to know that all the patterns have this XA, AB, BC, CD. It's just how we find it is different every time. So this particular one has the same retracement back down from from leg A to B, but because B went up to 78.6 this time, the Fibonacci retracement from A to B now will be a little bit different. So just be a little bit, probably, you know, when we get down to making point C, it might go for a deeper retracement rather than the Gartley pattern. So point C never goes beyond point A, very important. And then again, the retracement can land between anywhere between 38.2 and 88.6. Again, the deeper the pullback for point C, the easier it is for identifying the pattern. If we've got the pullback up to here, it's a little bit more difficult to identify because it's not looking like a full harmonic pattern in the end. So something to keep an eye out for as well. Now with the butterfly, it's a little bit not complicated, but it's just like an extra leg on here. Basically, I'll just talk you through it. So the final leg in the sequence is point C to D. And this confirms the butterfly pattern as it breaks point X as it extends. So the Gartley pattern did not break point X. We fell below point X, but with a butterfly, we are finishing above point X. So that's one good way to identify the butterfly pattern. Point D is an extension of both X to A and A to B legs. So what that means is there's an extension of A up to X and back down to A, which gives us the 1.272 and between 1.618. So D could fall anywhere between these two. And then also we've got a Fibonacci extension of A to B and then back down to A, and that goes up to 1.618. It can go to 2.618 up into this level, but rarely does. We are looking roughly at a confluence of these two levels here, the 1.272 extension of X to A and the 1.618 extension of A to B. So having a double extension or Fibonacci cluster at point D gives more of a clue of where the retracement is going to be. So once this has been established, it's more of a confirmation than the Gartley pattern because we've got two extensions going on, and it gives us more of a chance of identifying that reversal as well. So with that being said, we go into what a butterfly looks like as well. So as in the previous diagram, the final leg on the butterfly has a general guideline. So if B to C reaches 38.2 of A and B, so 30, so we were looking at a bearish one, weren't we? So we'll go to this one, it might be a bit easier. So if it goes down to 38.2, which is this leg here, then C and D could go all the way higher to 1.618 of B and C. So basically all this means is if it's a deeper pullback or a shallow pullback, then we might see more of a leg higher, or a kind of where it is now basically on this diagram of where point D is. And just like a Gartley, we are looking for this potential reversal zone. So when point D is established, then we start moving higher and putting those take profits in to see where we can capitalize on those particular reversal zones as well. So just to go through again what this all means, all this jargon here, just to make sure that it's fully understood. So we are looking at this time 78.6 X to A. So we are looking at the reversal, the retracement, sorry, of A to B falls at 78.6 this time around. So on the Gartley, it was at 61.8. And then when we move higher, it can fall between, the retracement can then fall between anywhere between 38.2 and 88.6 to get point C. And this is the retracement from B to C. And then we've got this 1.27 to 1.618, which means we have an extension, two extensions basically. So we've got one extension here and one here. I'll just go back so it's a bit easier to see. So this goes at 1.272 to 1.618, and this is the extension of X to A, and then we've got A to B as well on that extension. So this is basically what these you could say complicated patterns are, because we are looking now at something that can be very, very complicated, but in the same term can be very advantageous to trade as well. So I just want to show you my MT4 platform quickly, just drag it onto this screen. Now I've got a euro dollar chart open here for 1 hour. And the reason why I just want to show you, I'll just zoom out so it's a bit easy to see. It's a little bit harder to find these harmonic patterns on a 1 hour chart. It's just a bit difficult because we don't get too many swing highs and swing lows in an hour chart that we can sink our teeth into. However, I was looking at the NASDAQ 100 charts recently. I've got it on a daily chart, and I was speaking with a very good client that we have in the week about harmonics. And I wanted to show you that on this recent swing to the downside here, if we just put a Fibonacci retracement roughly about the high to the low, I noticed that a harmonic pattern was kind of being in progress here. Now, what I want to just show you here is if we just get the top end of this spike here and the lower end here, as you can see, this is the downturn leg. And now we've hit this bottom, we're moving up and we've hit the 61.8%. So if I just take you back to, let's go back to a Gartley, just so it's easier to see. So we've got this 61.8% leg, which is the first one. Now we're looking at the next pullback to form B to C. So now I'm going to do a Fibonacci retracement from A to B. So I don't want to make this too complicated. So I'll just move this a little bit this way. So now I want to do a Fibonacci from A to B. And as you can see here, we are moving between the 38.2 and the 88.6. We're at the 61.8, which is a very good sign that we are going to have a bounce now at this area and start moving higher for the final point D. So I'll just map this out so it's a little bit easy to see. So we've got from, this is X to A. Then we've got A to B. Now we are moving down lower from B to C. So now potentially I'll be moving higher to the 78.6, I believe it was, for the Gartley. Yeah, 78.6 to make point D. So that's a retracement of the XA. So I'll leave that retracement on here. I just need to put in, no, this one. I just need to put in the 78.6. So let's add. So 78.6, and we can put 78.6. Okay, and I forgot to add it, so that was clever, wasn't it? 78.6 add. I think I know because I need to change the color. As you can see, this was prepared earlier, which we should have done. Anyway, I think I've had a bit of a anyway, it's not adding, and I'm not sure why. I think I've just lost my touch on the Fibonacci extension, the retracements, but 78.6 will be up here somewhere. So that's where I'm looking for point D. So now we are looking roughly about here. Yes, so 78, I've just got a question from Martina. Martina. So yeah, 78.6, which is correct. Yes, correct. All right, quickly. So now what I'm expecting for point D is to run up to about here, and then I'll hit my potential reversal zone for the Gartley. And if we just join these patterns together, and I take away these Fibonacci retracements, so it's easy to see. As you can see here, it is forming, depending on obviously how far we go. We could go a little bit more here. And here it could be a bit here. So we are forming now, as you can see, a harmonic pattern. And this is on a daily chart. And as you can see, it is kind of working out. We've had this down leg. We're coming up to 61.8. We're moving back down between the 33.8 and the 78 and 88.6, sorry, of the Fibonacci retracement. And now I'm expecting point D. I'm expecting a bounce here, not too much lower than where it has gone now. It could, however, go a bit further down, as we've seen on the examples, possibly down to roughly about here. However, we are now looking like a harmonic pattern. So the potential reversal zone will be here, and then I'll be possibly looking at my take profits at the original 61.8, and then if I'm feeling adventurous, we'll go down again, possibly down to where this potential leg finished, and then probably no further than that. And then a stop loss would be roughly about where it started. So this is, you know, as I said, I noticed this in the week, and I want to share this with you because trading harmonic patterns do appear in the market. I was a little bit skeptical at first with trading with harmonics because, you know, whenever do you see a harmonic pattern in the market? Well, there is one developing right now. As I said, we've had this swing low halfway and then back down and then a move higher. So it's important to note that we are looking now at another move to the upside. I've just been asked, can we watch a recording later? Yes, this is recorded on YouTube, and please let me know if you'd like the slides sent to you. Please send me your email addresses so I can send you the slides of the presentation, and we can. I'll be happy to send them to you as well. So getting back to the presentation, I just want to take you through another couple of patterns. So this is the crab, and another popular one. So after the XA leg, we are moving up to point B. So again, this is now not just one number of the 61.8. We are falling between the 38.2 or the 61.8. I haven't gone through every single leg like I did here because I'm presuming you're getting the general idea now of what these numbers mean. So we're basically, I'll talk you through them one by one though. So X to A, we're looking at the 38.2 to 61.8 leg and of A to B. And then we're going through another retracement back down from B to C, and this could fall anywhere between 38.2 and 88.6. And then to make point D, we've got extensions as well again. So we've got falling point B, the next leg, B to C, can run up to 38.2 to 88.6 like we've seen. But C should never exceed point A. So a lot of these patterns, I believe it's just the shark that can move higher, because the reason it's called a shark is because point C goes above and it's supposedly like a shark's fin. So this is the reason why it's called a shark. But for a crab, Gartley and butterfly, it doesn't go, C does never go beyond point A. So I've just been given some more email addresses. So please send them. As I said, I'll be able to send you the slides and any questions that you may have up until now. And following the B to C leg, prices then reverse again, moving against the direction of X to A. The CD leg is the longest and usually reverses between 161.8 of the XA leg and extreme 224 to 361.8 extension of the BC leg. So these are just extensions. So I'm going ABA and I'm expecting this D leg, as you can see, like the butterfly, the Gartley point D finished below X. But as you can see here, I'll just go back on the butterfly. D finishes above X. However, for the Gartley, you can see D finishes well below X. So this is why we have more of an extension. Like here, we're having a double extension here to confirm this push to the upside. And we are looking to see another move to the upside. So it's been asked, what YouTube channel, please? It's the official Orbex YouTube channel. And last but not least, we've got the BAT. As I said, I just want to run you through the four most popular, just so you get a general idea of what's going on. So the rules are for the BAT is the AB leg can be traced between 38.2 and 50%. That's what we've got here, 38 between 50. So if we go for a bearish harmonic BAT, as I said, we've got the big downturn. And then as we go from A to B, we are now looking at this retracement. And then B to C leg can be traced between 38.2 and 88.6. That's what these two figures mean here. And then C to D leg can be traced up to 88.6 of XA leg. So that's why we've got this 88.6 here. And then finally, to get to point D, we have an extension of the AB leg. So what I'm going to do is I'm going to put a Fibonacci extension of ABA, and then you're going to see this run up to 1.618 to 2.618 here as well. So before, I'm just going to go quickly back on the presentation just to fill you in on any questions you may have, but just quickly looking at the pros and cons of harmonics. I want to be honest here and see, obviously I'm a trader myself. I want to give you the most bang for your buck, let's say, most honest examples that I can give of harmonics. So the pros are they are frequent and they do repeat, and they are kind of reliable at producing probable market setups like we've seen here. It's a very good example here that as you can see here, our harmonic pattern is generally forming. It is more worthwhile to look at then an hourly chart because, or a 15-minute chart that I've got the dollar yen on, because as you can see here, it's not really doing anything for a harmonic. But 4-hour charts, daily charts, weekly charts, you can see more of a development, and obviously it is for more of a long-term trader rather than a short-term trader. If you see here, this started developing on just at the end of November, and the first down leg came in March. So, but the thing is, you don't have to trade this leg. This is just the first initial leg. Once you start seeing harmonic patterns forming, so when we got up to the 61.8% here, I'll just put that back on so it's a lot easier to see. When we started getting on to the 61.8%, as you can see here, you can probably start planning your harmonic pattern trading, and you can probably think, well, I believe now that I've seen a bounce and a move lower here, I'm just going to cash in on, well, this is the NASDAQ, so it's well, just over 1,000 points. But if it was a euro, if it was a Forex pair, you could probably get maybe a 50 to 100 pips on this trade from the B to C leg. And now if I want to put a buy position in on this harmonic pattern that I believe is forming, I'll be able to run this up to 78.6. So again, you know, on the NASDAQ, it's going up to over 16,000. So this is another thing that you can think of as well. So something to look out for as well. And Going back to the pros, trading rules are usually standard between each pattern using the Fibonacci rules. It works in all time frames and in all market instruments, but like I said, is more identifiable on the bigger time frames and can be used in conjunction with indicators such as the RSI and MACD. However, now the cons, they can be complex, highly technical, and difficult to understand. Trading standards are very precise. Looking out for a pattern could mean missing out on a trend as well. Conflicting Fibonacci zones, retracement extensions can create difficulty with identifying reversal and projection areas, and the potential reversal zone of certain harmonic patterns can spread over too many pips. So these are things to look out for when I've been trading anyway on these particular harmonic patterns and seeing what is looking for as well. So that's the end of the presentation. I just want to go back again and just to quickly go through what we're looking at. So we've got the downturn. This is for a bearish pattern. For any bearish pattern, actually, you've got the first downturn, X to A. Then you've got the pullback. On this pullback, we've got the fact that we are now looking at the 100% from A to B. So now A to B, 100% retracement, and that gives us point B, that gives us point C, and this can fall anywhere between 38.2 and 88.6, depending on what pattern it is. We've seen the other patterns that can fall between different numbers, and also different patterns that can fall between not only the 61.8, run up to 78.6, or actually be a bit lower. And then the next one is C to D, and that's identifiable by, once we've established C, then we're going to have the same Fibonacci set up from X to A, which will give us our 78.6. Most of the time it is 78.6 that will make D. However, for the patterns that exceed point D, then we have the extension tools, which is what we have here. And then we've got the last one, and they're identifiable by different types of lengths of the Fibonacci extensions and retracements as well. Then we've got the take profits. So this is the potential reversal zone here at point D. When that's been established, we start to see them move lower. 38.2 and 68.1 are generally the most popular take profits before we get to the 100% reversal, which is point A here. And where to look for the stop loss? Well, as I said, a lot of traders do like to go roughly about the point X, the beginning, but failing that, if you want to be a bit more adventurous, then the Fibonacci extension of points A, B, A to run up to 3.618, sorry, is kind of popular as well. So just to recap on what these mean, as I said, don't be too put off and shy or nervous about when you see these different numbers, because there is clarity behind the confusion. So the 618% is basically a retracement of A to B to create this point B. And then we've got to create point C. It can run anywhere between 38.2 and 88.6 of the retracement of B to A. And then from C to D, sorry, I missed out 78.6. 78.6 is a retracement to form point D. And that's using the same Fibonacci retracement that we got X to A on. And then remember, this is for Gartley. And then we've got this expansion of the Fibonacci from ABA. So just quickly go back on my MT4 platform. And I just want to also put in a Fibonacci expansion here, just to show you roughly. So we're going to go from here. It's usually got 3 points. So A, B, and then back down to A. So there's a lot of jargon and confusion on this chart at the moment, but I just want to show you quickly. As I said, this 1.27 for the Gartley is where point D usually runs up to, and this is just an extension of ABA. So I'll just move these other Fibonacci patterns so they're a little bit easy to see. Oh, delete them all, which is quite helpful, I suppose. So let's go again. So A to B and A, going back down. And as I said, this is the extension. And this is where point D is most likely to start running up to, and where we expect it to stop roughly. As I said, if we do get point D going above the start of point X, which is here, it will not be a Gartley. It could be a butterfly because it does run above, but it won't be a Gartley. So because I've gone up to 61.8% here, this Gartley pattern will be voided, because if it was a butterfly, it would run up to 78.6, which is roughly here. So just keep that in mind as well, depending on what pattern you are looking for as well. So I've just got another live question. How do you know when a harmonic pattern is being in development? Well, as I said, let me just get rid of some of these lines here because it's a little bit difficult to see on the MT4 platform. So you don't really know, first of all, where the harmonic pattern is being created until we have this very detrimental downturn or a upturn, depending if it's detrimental or not. So once this has been established, this first leg X to A, and we see a bounce, then we are looking now to see where this retracement is going to land. If we land between 78.6, which will roughly be about here, or 61.8, which is like we saw it earlier here, or maybe a bit lower, depending on what pattern it is, then we can start determining what particular pattern, if it's a crab, butterfly, shark, Gartley, whatever you want to look at, we can start then looking at what it could possibly be. So would it be a Gartley? Is it going to be a butterfly, crab, bat? Depending on what these retracement levels are and what we are looking at here. So I've just been asked another request for the PowerPoint slides. No problem. Keep sending me your email addresses and I'll be able to send them to you. Obviously, I've got returning viewers, so I already know your email addresses. That's no problem. So yes, so that brings us to pretty much the end of the presentation. I just like to go through the pros and cons just to let you know. I know I've gone through them, but just bear in mind that when you are looking out for a harmonic pattern, history does repeat itself. So they are repeatable and they are quite reliable. However, they can be very complex, and they can sometimes, when you are looking for these retracement and extensions, you can get a little bit confused. So just basically, hopefully with my slides here and the step-by-step legs that I've given you, hopefully this will give you a better indication on what to look out for. So as I said, the first downturn, then the A to B, B to C, and then finally C to D. And when we've got that D zone, the potential reversal zone, then we can start looking at how many pips we can bank, whether it's bearish or bullish. So just keep that in mind, and I'll hang around on the chat for another 10 or 15 minutes or so. So any questions that you want, any email addresses that you want to send me to send the slides, and I'll be happy to do so. So just a reminder that next week we've got the Beginner's Guide to Elliott Waves, very important trading patterns, I would say, very important in the market in today's world. There have been more and more popular over the last 10 years since the MT4 platform has been coming, well, 15 years actually, since the MT4 platform is such a reliable tool to use. And we are looking at waves in the market, and I'll go through that in a lot more detail. All the patterns, we've got triangles, diagonals, just to name a few, zigzags, double zigzags, triple zigzags. We haven't gone to quadruple zigzags yet, but I'll go through all the patterns and let you know what's happening with the Elliott waves. After that, as I said, we've got candlestick trading, all the patterns, dojis, hanging man. My mind's gone blank now, but most of the probably top 20 candlestick trading patterns you can think of. We'll go through all of them to see how we can jump on those opportunities. And then later, for next month as well, as we go through these presentations, we've got trading the gaps, like I mentioned at the beginning of the presentation, and also how to trade the Ichimoku cloud as well. So a lot of indicators coming up, a lot of ways and reasons to trade. And once again, thank you very much for your attention. Thank you for joining me, and we'll speak again soon. Like I said, I'll be on the chat for a little while longer, so feel free to send me all your questions or any other email addresses, and I'll get back to you as soon as possible. So have a great trading day ahead, a great week ahead, and we'll speak again this time next week. Bye for now.